Hey everyone, glad to be with you today. Jake Weatherford and Adam Lee. We are going to go into a Q1 2023 market overview, and we will dive into a little bit of what happened in Q1 of 2023. We'll talk about stocks, bonds, and international stocks, US stocks, break down different markets. Adam's really going to dive through this for us, and we will also share some slides on the video and perhaps after the video as well. And then we'll get into a little bit of explanation of current events, why we are planning to start covering them, and what we're going to do about those, and maybe what we're not going to do. So this webinar may be a little shorter than our last ones, or maybe we get to talking and it's longer. So without further ado, we'll dive into the Q1 market overview, and then we'll jump right into some current events.
Perfect. Yeah. So to kind of riff off of that into the market overview, we're looking here at the longest or the shortest period of time we're looking at is quarterly, and obviously, as everybody knows, markets are moving every day, every minute, every second. And right now I can turn on the news and I can get a quote for what the major market indices are at, and 30 minutes from now I'll get a different quote. But really, that's not helpful to look at for a long-term plan, right? Like if we're going to make decisions and help clients be successful, we can't be changing the plan every second, every minute. We need to have portfolios that are prepared for longer periods of times where we don't have to be reacting every second, every minute to pieces of news. So, anyways, to bring that back to what we're looking at, quarterly returns, in my opinion, is about as often as you want to kind of look at the market for something meaningful. And it's probably even a little more frequent than you need to look, right? Like you could probably look every year or every couple of years because of the type of portfolios we're building and the long-term exposure. But okay, with that big preamble, getting into actually what happened last quarter. So stocks were up last quarter, kind of across the board. The US did best. International did pretty well as well. Both of those around 7 or 8%. Emerging markets up 4%. And then real estate even up 1%, which, hearing news recently about, interest rates going up, and you might have heard some jitters about commercial real estate. This is just a reminder that the market, went down a lot last year, pricing in some of those expectations of things that were to come. And so, even if everything's not all of a sudden rosy out in the real world, the fact that maybe some of the worst case scenarios aren't coming to fruition comes through in higher stock prices in Q1.
And that's a good point, just to highlight that the market often is pricing in future events. And really, we think if you believe in market efficiency, the market is always doing that. So that's why, and we'll dive into this more later, but we want to act rather than react. We want to prepare for events rather than react to them, because we know, again, that the market is forward looking and prices those events in. So we'll dive into that more later. I liked that you highlighted that there.
Absolutely. And bonds, to that point too, had a really, really good quarter. Interest rates have been going up, and interest rates went down a little bit last quarter. Actually, partially around some of the SVB stuff. We had a bank that failed. So definitely some interesting things in the market last quarter, but all of that translated into good for stocks and good for bonds. So to go into kind of a longer term view, this zooms out and says, okay, well, what's happened over the last year, last 5 years, last 10 years? And so this is really what's more important to look at is the longer term trends. Obviously, we're not planning for clients to be successful over 1 year. We're planning for them to be successful over decades. And so as you zoom out throughout any period of time, you almost always see the longer the time period, the better chance there is that you have a positive return and a return that's kind of closer to the long-term average. So you see, you look at the US over the last 10 years, even with kind of the downturn over the last year, US is still up over 10% over 10 years. And that, can allow any plan to be successful if the U.S. performs like that on a long-term basis. Bonds also up over a 10-year period, a 5-year period. So again, kind of the message is, if you look, last quarter did well, last year didn't do so well, but really both of those are too short of a time horizon to be making a plan about. And over the longer term, we've seen gains kind of across all the asset classes we invest in.
Yeah, very interesting.
So U.S. stocks in particular, just a reminder, over half the kind of value of the stock market in the whole world is here in the U.S. And a lot of times people kind of get this confused in their head of, U.S. companies sell to U.S. consumers and make U.S. things, and international companies sell to international consumers. It's really not that simple. Apple sells phones all over the world. And then international companies like Shell sell oil right here in the U.S. and have refineries right here in the U.S. And so, saying U.S. stocks are over half of the world stock market is really just saying U.S. companies sell a lot of stuff internationally, U.S.-based companies. But, probably the largest part of most people's portfolios, certainly the largest part of our clients' equity portfolios, and U.S. stocks, did well. Larger stocks actually doing a little bit better over this past quarter, and particularly growth stocks doing a little bit better over this past quarter.
Yeah, I would just like to remind people that the 59% U.S., or maybe to simplify that, the U.S. having the majority of the market share around the world, that's where we start with our portfolios too. So if you're in a 100% equity or stock portfolio, your exposure to the U.S. is somewhere similar to that 59%. Because, again, we want to start there. We want to start with the world market cap. And then if we have reasons to shift one way or the other, we'll do that. But that's always a good place to start with our allocations as well.
Absolutely. So going on to international, so this is a big chunk as well. International stocks, like I said, they're some of them are truly things that you might not recognize, like a consumer products company in South Korea, but a lot of them you would find actually are maybe names you're more familiar with, like Shell as an example, being a huge international company that still has a lot of impact here in the U.S. International stocks up as well over the quarter, up even a little bit more than U.S. stocks. And similar patterns there that, large stocks were tending to do pretty well, and growth stocks tending to do pretty well. Finally, we have emerging markets. So this is kind of an interesting category. We are a little bit underweight emerging markets typically. These are, countries that have maybe less developed, less mature markets than maybe like, Germany or something like that that's been around for a long time. So emerging markets didn't do quite as well as U.S. and international. There's a lot of nerdy reasons I could get into with that. But the important thing is the reason we allocate across all these different types of assets is because, we want to make sure all our eggs are in one basket. In the same way we don't just buy one stock in the U.S., we don't want to only be exposed to U.S. companies. So, we're okay. We expect every quarter one of these asset classes to do better than the other. And the point is not to try to only be exposed to the asset class that does the best every time and, sell all your U.S. stocks and buy international and then sell all your international and buy emerging. We want to spread our risk out among those buckets.
Yeah. One fun way I think about or talk about emerging markets is they're kind of the small companies of the international countries. And in a sense of small companies are usually newer, less developed, things like that. So for some people, that's an easy way to understand like what actually is an emerging market. Well, it's an emerging market, similar to a newer or smaller company. So not that they, and Adam could get in a lot more to how they're similar to smaller companies or not, but we do see emerging be more volatile, typically than the developed countries in the international space. So that's a fun way for me to think what's the difference between emerging and international.
Absolutely. And so this is a great slide, and I think actually last quarter when we looked at this, Turkey was leading the pack, and it had something ridiculous like 60 or 70% returns. Don't quote me on the exact number, but it's pretty high. And that didn't make me confident that they were going to be at the bottom of the pack this quarter. It really is like one quarter to the next. It's almost no predictability in terms of, but it is interesting to look at this of just to underscore the point that we shouldn't be chasing historical returns.
That's right.
Czech Republic was actually the place to be this quarter. I couldn't have guessed that. You couldn't have guessed that. And Turkey, if you would have looked at the last quarter and said, hey, Turkey's doing really well, let's put all our money there, you would have only been worse in Colombia this quarter. So I put this out here not because we are using this information to pick countries, but just to underscore the point every quarterly update of how what a dangerous game it is to try to look at what just happened and assume that's going to happen in the future.
That's it. It's good.
Fixed income. So this slide has a ton of stuff on it, but the basic message on here is that a while ago, a year or two ago, interest rates were really low. Short-term interest rates were low. Long-term interest rates were low. What's obviously happened over the last year or so is inflation has gone up. The Federal Reserve has tried to combat that inflation. The way they do that is they raise interest rates. The Federal Reserve raises short-term interest rates. That's the only thing they can control is the overnight rate or the 1 month rate, basically. And so they've raised up that short-term interest rate. Usually when short-term interest rates go up, it does pull longer-term rates up as well. But we've been in this funky situation where short-term rates are really high, longer-term rates are higher than they were, but not quite as high as short-term rates. And basically what's happened is over the last quarter, as the Fed has, a lot of people's estimation, we'll see if it actually is true, has gotten kind of closer to their final destination in terms of where they're raising rates to. As we've seen, demand in the economy cool some. We've seen some stuff like SVB, that bank go under. Sort of the expectations for rates in the future have come down a little bit this quarter. That's part of the reason that bonds performed so well in this quarter. But also, if you looked out to, what's if you were to go borrow money, it may actually be a little cheaper this quarter than it would have been at the end of last quarter. And no prediction exactly where it's going to go in the future, but we, at least for the first quarter, I can report in a while, have stopped the trend of ever increasing interest rates. And who knows if that'll continue, but we have at least plateaued from where we were.
All right. Well, with that, I'm gonna switch slides here, and I've got pulled up in front of me really a representation of market downturns or recessions in the past. So going along with what we opened with and what Adam opened that piece with is making sure that we have the right time horizon in our brains to match our investment plan. Said another way, making sure that we're not focusing too much on short-term events while ignoring the long-term, especially if we're investors that are either accumulators or we're in a retirement that could last upwards of 30 years. Often our time horizon is longer than we think. Even with investors that are retiring in a few years, they certainly don't need 100% of their portfolio in year one. So even those people that are very close to retirement, they also have a long time horizon, although it's sometimes hard to accept that. So again, we're doing quarterly market reviews. We also, Adam mentioned SVB a couple times, Silicon Valley Bank, which I'm sure you've all heard quite a bit about, and hopefully you watched our video to explain a little bit to you. There's also other banks that we know have defaulted and things of that nature. Adam and I and others from our firm, we're going to be covering these things in articles and in videos. The reason we're doing that is to keep people informed on what's happening and to keep you informed on how that could have an effect on you. What we're not trying to do is give the sense of, hey, this event happened, you need to do this. That's quite the opposite of what we want to do. So on this slide, it kind of tells us why we don't want to do that. One of the first trends I think that you can see from just peeking at this chart quickly is that from left to right, it's going up. It starts lower on the left and it goes higher on the right. This is about what, Adam? About 100 years of data. And that is one constant trend that we see from this chart is that it's going up towards the right. Now, in order to actually have realized that return, you will see on this chart that you would have had to put up with a lot of short-term events. World War II, and then I'll go to the most present day, COVID-19. We can go back to the Great Depression. We can go back to 2008 when we had the market collapse in the real estate market and also the 50% dip in the stock market. So there's if I just quickly count, there's 10 to 15 different events that are highlighted on this chart. And really, if you zoomed in further, you would see a lot more than that. There are many short-term events that do cause the market to sometimes go down quite sharply. But again, what we have to do is put up with each one of those to realize that long-term trend, upward trend. So just digging into a couple of those, Adam, I think we can go. We'll start with the most recent one first. I pulled up this COVID-19 slide, and I don't really want to dig in too much to what happened in the market. I'll let you put some color into that. But what we saw with COVID-19 is, and what we heard a lot is this time different. And I think you can see from the chart that every single one of those times is different, right? There's a lot of difference in how quick the market dips, how quick it comes back, etc., how long it stays down. And so really every one of them is different, but we also know that every one of them is somewhat similar in the same, in that we don't know when they're going to end. And neither do we think anyone does. No one can predict the future. So again, just backing up and going back to the fact that what we want to do is we want to prepare our client portfolios to be able to put up with those events and not act or not change through the event. So with COVID, Adam, I know we went down really quick and then came back, I think, as quick as we ever have in history. So anything about this event that really is worth highlighting?
I think the two things I would say is, one, exactly what you already did is just, I mean, this was like a lesson in market volatility about 10 times as fast as normal. Mm-hmm. And so I think that's good in the sense that it showed kind of the principles of being a long-term investor in a really short time horizon and provided that lesson. I think on the other end, though, we can be a little bit, learn the wrong lesson from it, in that, like, that was a really fast dip and a fast recovery. Mm-hmm. And really being a long-term investor, it involves dips and recoveries, but typically slower dips and faster recoveries. And that links to my second point on it, is that, there's two things that can bring down markets. Really bad news that was unexpected. And the key there is unexpected, because bad news that everyone expects is already priced in, but also uncertainty. Mm-hmm. And COVID was both, right? Like, it came, who had on their bingo card, November of the previous year, we're going to have this massive thing that shuts down, the economy, and there's all, affecting different countries and all this kind of stuff. And also, it was so uncertain because, think about, market participants are used to estimating the odds that a bank will collapse or whatever, but, everybody at all these hedge funds was having to brush up, on their biology, I guess, of trying to figure out what was going to happen. And so it really perfectly demonstrates the two things that can cause markets to rocket down and rocket back up, which is unexpected bad news and uncertainty, and then the resolution of that uncertainty. And it wasn't good news at the other end of the tunnel. It still was really tough, but we went from having almost no idea what was going to happen to our lives and the economy to very quickly having a better idea of what was going to happen. And that gave everybody a lot of confidence to, reinvest and right. Make plans for the businesses and themselves.
Yeah. It also, the only other point I'll have here, and then we'll just go to one more and we can wrap this up. It's also interesting how quickly we can forget. Yep. Now everyone's feeling, well, the market's just kind of flat and things of that nature. It's amazing that not long ago we were going through a global pandemic, and yep. we can quickly forget how that felt. And so a lot of times when the market is flat or the market's going up, we get questions of the opposite. Hey, why don't we increase our equities? Why do we have all these bonds? Bonds are a little easier to hold now because they're actually giving us a pretty good yield, but we get questions on both ends. And, really most of the time our answer is the same. Have your goals changed? If the answer to that is no, then typically if your portfolio is set up correctly in the forefront, we don't have to change anything because of events or because events end, because we don't know when the next event's going to happen, and we don't know when the next event's going to end. So the only other slide that I'd like to highlight here is the global financial crisis. Definitely still a lot of us can remember 2008, where we had the subprime mortgages fail, and then we had the global financial crisis, and we did. First of all, we went down, just about as much as we ever had, and we stayed down, right, for a while. And so, kind of the opposite of the COVID-19 dip and recovery, this one was sustained. And so this is a good, just to kind of bring it all back to the point of this video of, hey, look, we are going to cover some recent events. We're not doing that to tell you that you need to do something. Well, sometimes the best thing you can do is nothing, right? A lot of time, maybe the majority of the time, the best thing you can do, as long as your plan is good to start, is do nothing. In other words, during the global financial crisis, the duration of it being 16 months, one of the worst things you could do, Adam, is sell your stocks and flee to safety at month 12 or even month 8, right? Hey, we don't know how long this thing's going to keep going down. Well, neither do I, but we also don't know when it's going to go back up.
Yep.
So even if you sell your stocks at month 8 or at month 16, you don't know when to get back in. The worst thing that can happen really when you sell your stocks when the market's going down is the market shoots back up, and then you're like, oh, well, now they're more expensive than when I sold.
Yep.
So a lot of the reason that we think it's prudent, the reason we run our business the way we do, is because we can control having a good plan at the start, and we can control how we act and manage our emotions. What we can't control is trying to know the future of when to buy and when to sell. So a lot of times it's not the easy thing to do, but simplicity wins, and doing nothing with a good plan is better than doing something and destroying your plan because, again, we can't predict the future.
Yeah. And that really, it makes me think a couple things on that. One is that it really is a unique, and maybe it's corny to call it a superpower, but like the superpower of our clients is their time horizon, right? If it is a totally different story if you were out there, trying to manage money in a way where you need to make money in the next year in the stock market.
And you would manage it a lot differently.
Absolutely. You would be much more reactive to events. You would take risk off the table when these things happen because you don't have the time to watch something recover for 2 years, 3 years, 4 years, 5 years. You don't have that superpower of, hey, I'm a long-term investor. I can see my way through these short-term risks, and I can take the benefit of the long-term growth in the economy that has been so reliable and predictable for hundreds of years. The other thing I love, which I don't have the stats on me, but maybe we could do it in a future webinar or something, but is really, really illustrative, I think, is going through the exercise of what if you put all your money in the market right before it started going out in 2008, and you took it all out, let's say this most recent peak, like last December. I think a lot of people would think like, oh man, you must have had a really bad experience. Mm-hmm. And, maybe I'll tease that for a future video. We can show that, but it is
shocking.
Yeah, it's shocking how powerful it is to have a long time horizon, even if you had the absolute worst timing on the way in and worst timing on the way out. Just time in the market can make up for a whole lot of bad luck in terms of specific entry and exit points.
That's great. Maybe that's where we start our next webinar and dig into that a little bit. The timing aspect of it and how that affects my plan going forward, because that's great data. Well, again, just to wrap up, we want to act, not react. So we want to set your plan up to be able to fight through any of these short-term events. We don't want to react to short-term events because we know that our superpower is our longer time horizon. So that's the main message from me. Any parting words from you?
I think that covers it. That's all of it.
Great. Well, with that, I just say that we are also always interested in looking for questions that you may have to answer in these webinars. So if there's anything, feel free to drop us an email or a phone call and let us know something you'd like for us to discuss in the future. And with that, we will call this good, and we will see you again in another quarter.